This is my list of ultra high quality stocks, and in this video, I'm going to share with you my methodology for screening for ultra high quality stocks. In other words, how do these stocks end up on this list? And in subsequent videos I'm planning to make, I'm going to share with you some of my insight into how I would narrow down from this list and choose stocks that I would actually invest in, and share with you my own personal investment, or me making the investment into these stocks following the process in this series of videos. So if that sounds like something you're interested in, you know the drill. Smash that like button to help me out in the YouTube algorithm, and hit the subscribe button for yourself. Now, on that note, let's talk about it here, and we'll start by talking about investing in quality stocks, or the quality factor. Why would you be interested in investing in quality stocks? And I know when I say it like that, quality stocks, it just seems like, yeah, well, we should. But there are other factors out there and other things that might earn higher returns. So why quality? High quality stocks are appealing for a few reasons. First, their risk characteristics. They typically have lower volatility and lower drawdown than the broad market. So when the broad market is in a bear market, a recession, a depression, etc., or it has just been sideways for a prolonged period of time, high-quality stocks are typically doing relatively better than the broad market. And this is really appealing to me because this makes me comfortable having more of my capital exposed to equities as opposed to just sitting on the sideline. Second, there is potential outperformance. This research paper right here shows the MSCI World Quality Index going back to 1987 relative to the MSCI World Index and the S&P 500. Now, let's just talk about the S&P 500. I think it is really irrelevant to have it on this chart because that is just US stocks independently here, whereas the World Quality Index is obviously global stocks. So the most effective or relevant comparison would be to the market cap weighted MSCI World Index. And we can see the difference in performance here over this time period using this back-tested data has been substantial. It shows a substantial outperformance of the higher quality stocks. Mind you, this is not the exact same quality in any way that I screen for. I use different quality metric behind it. But ultimately here, the point I want to make is that there is potential outperformance associated with investing in these quality companies. And I have to stress that word potential because this is all back-tested right here, right? Like nobody actually got these returns. This is all simulated, and we really don't know what will happen going forward. I guess we could pull data on the MSCI World Quality Index here from the end of 2021, right? And look at that. We don't know how it's performed out of sample. You always have to keep that in mind. But by and large, it has been my experience through the research that I've done and the investing that I've done that quality companies do deliver a little bit of outperformance. Now, going from that, having or narrowing down by quality gives us a good basket of stocks to invest in here, right? So this is a pretty long list. If we look at my count, it is 89 companies right here that I've identified as being ultra high quality. And this is a good starting point to make other investments because you're really not going to get hosed if you invest in any of these companies. Now, that said, I should give the disclaimer, this is not investing advice for yourself. This is for informational purposes based on what works well for me and my own risk tolerance. Do your own due diligence and make any investments based on your own data and decisions, not my opinions here. But in my opinion, and I am comfortable with the fact that if I make investments in these companies, I'm most likely not just going to get entirely wiped out. Whereas if you're just looking at the entire market, you've got a lot of junk in there, and you might get some rocket ships that really take off, but you're also going to get a lot of junk. I like having quality as a baseline. And then finally, personally speaking, as a business owner and small business investor, that's what my career has been for the last 15 years. Back in 2010, I started a business, did I was fortunate to do quite well with that. Since then, I've acquired other businesses, I've started other businesses, I've sold other businesses, etc. And through all of that, I've really made a really strong relationship, I guess, with quality in any of the businesses. And I feel like businesses that are going to do well going forward and, in terms of the market, following those businesses and investing in those businesses will do the best going forward. And that is my own personal conviction. And maybe I really didn't articulate that very well, but ultimately my thesis is that quality businesses will generate outsized returns in the long term. And I also have some other views related to market cap weighting where, I really don't think that market cap weighting and the performance that we've seen historically, that all of the bogleheads and passive investors really base or build their entire investment thesis on, I don't believe that that will necessarily sustain itself going forward, and that the market will continue to grow at those rates. So rather than just, throwing money into the market blindly, regardless of fundamentals, I like to look at high quality companies with a strong fundamental metric here, as you're about to see. All right. So on that note, let's talk about why these companies now are in here, since you have an understanding of why I am interested in and why I like quality investing. And we've already covered there are 89, actually only 88, 89 was counting this one here, but there are 88 on this list, and they range in market cap size from $3 trillion all the way down to the smallest one here being Yeti at $3 billion. And that was based on March 2022 data of this year, 2025, that I am recording it here. So my entire investable universe that I started from was the S&P 500 and the S&P 400. That was to get me as close to the Russell 1000 as I could, because with the screener I was using, it did not have the Russell 1000 in there. That ultimately got me about 900 companies, mid-cap and bigger. So very, very close to the Russell 1000. If you did this with the Russell 1000, you would get similar results. And actually, if you did this with the Russell 2000, you'd also probably get very similar results, because I think a lot of the smaller ones would not be caught in this. All right, so universe, S&P 400, S&P 500. The screen is the highest quintile of ROIC consistently for the last 3 years. So right here we see the ROIC, return on invested capital, right there for each one of these companies. And this is in the prior year. But I went back and I fleshed out all of the companies that were also in the highest quintile for the 2 prior years to that. So the last 3 years, and that gets us this list. So of the 900 companies, 88 of them have been in the highest quintile of return on invested capital for the last 3 years. Now, let's talk about that return on invested capital. All right. That is effectively a measure of what kind of returns these companies get on the capital that they are investing into the business. That includes debt and equity. You may be familiar with return on equity. It is a similar metric. People often call it the cousin metric, but it does not include debt. This accounts for that. And in theory, if these businesses or a business is earning a return on invested capital higher than their weighted average cost of capital, they are creating value. If they are generating a return on invested capital less than their weighted average cost of capital, they are destroying value. So all of these businesses here in this highest quintile of ROIC are going to have, maybe there's some extreme exceptions, but they're going to have a higher return on invested capital than they are weighted average cost of capital in the highest quintile. There may be some extreme outliers or some extremities, where their weighted average cost of capital is high, but that'd be very, very unlikely, particularly for these companies that have been in that highest quintile consistently for the last 3 years. So that is how they got, or that is how they're in the screen. That's a little bit on the return on invested capital. There's been a lot of research into this. Let's just talk a little bit about this, because this segues into what will be the next video here. And I've got a couple research papers up, and I'll just go through them actually in this order. This paper is an interesting one that finds that excess returns are not necessarily the result of risk, because there's a common theory associated with the efficient market hypothesis, and that is that your return is a reflection of the risk. So you invest in riskier stuff, you get a higher return. Well, in the case of quality, you get the excess returns, but you don't get any actual risk. And this one right here, this is a really interesting one that looked at investing in the different quartiles of return on invested capital. So quintile is the highest 20%, quartile would be the highest 25%. And you can see that relative to the Russell 1000 or 3000 equal weight, the highest quartile and the second quartile earned substantial returns above the Russell 3000 equal weight. Quartile 3, was about on point with that. That's actually quite interesting. And then quartile 4 was just, the real poor performers. This one here shows, another period of time with the top 50 ROIC stocks, bottom 50 ROIC stocks. But one thing I need to point out is all of this research is not based on companies that are consistently in the highest quintile of ROIC. As we get further into things here, these are two really good papers by Michael Maubasin. I don't know exactly how to pronounce that, but Michael Maubasin is what I'm going to say. And they take a look at ROIC and how this ultimately leads to returns, is associated with returns, and moats as such. So two good papers here to read. One of these papers has a really good takeaway that I like. And I'm not seeing it. Let me just do a control off. Here it is. The research shows that these companies that sustained high ROICs and high sales growth generated much higher total shareholder returns than companies with low returns and growth. Interestingly here, they touched on this high sales growth. And what was uncovered and published in this research paper here was that simply having a high ROIC was not enough to generate excess returns, because the expectation that they have the high ROIC going forward is built into the price of the stock. All right, so if you're paying a higher price, for that, or you're paying for the, consistent ROIC growth going forward, you're ultimately not getting any return premium. Ultimately, the companies need to continue growing. And if a company generates high ROIC but does not keep growing, it just kind of becomes a cash cow, and it's just distributing and returning capital to shareholders, but the actual stock price is not actually appreciating. So in the next video, I'm going to talk a lot about these growth metrics here that we can tie into these ultra high quality companies, and that is they have had ROIC in the highest quintile consistently for the last 3 years, because, as Maubasin points out here and uncovers, that the high ROIC itself is not enough. You have to ultimately identify companies that are going to grow going forward, A, and with that, I guess this is really AA, are not valued accordingly. They have to be undervalued, because if the value of that growth and their high ROIC is already built into that, you're not going to earn the excess returns. On that note, guys, I hope you found this video helpful and insightful. Stay tuned here as I come up with some more videos relevant to this. ultimately on growth in selecting from stocks that fit this screen, and then subsequently my investment into those companies. If you found this video helpful and insightful, you know the drill. Smash that like button to help me out in the YouTube algorithm. I am calling it a wrap and signing off on that note.